Hello, today we will begin explaining a new chapter. The chapter is about evaluating single projects. The objective of this chapter is to determine whether a certain project is profitable or not using the concepts that we have learned in the previous chapter, time value of money. The methods used for evaluating any project include the present worth, annual worth, internal rate of return, and the payback period. We have explained previously the present and the annual worth. In this chapter, we will learn another methods, new methods related for evaluating the project. But before choosing the methods of evaluation of any project from the financial aspect, we need first to understand that a project must provide a return that exceeds a certain level established by the company. If I exceed this level, then I will say that this project is attractive to me. So any firm will determine the minimum attractive rate of return of income so that it will say this is a good investment or not. Now the question is, where do this number come from? How do companies set their minimum attractive rate of return? There are several elements that will determine the MARR. Let's say, for example, you have a certain amount of money in your bank account and the bank is giving you 10% interest. And you see that there is a project with an opportunity that provides a 12% rate of return. So you will say 12% is better than the 10% that the bank is giving. So you will go for this project and do the investment. However, on the other hand, if you don't have the money and you will have to take a loan from the bank and repay it with the interest, you will say, I will not do this project unless the rate of return, let's say, is 15%, so that to cover your expenses and repay the loan of the bank with the interest and to make a profit yourself. So each situation is unique. Each company will determine what will be the minimum attractive rate of return that it will accept. Now, also sometimes it depends on the type and the purpose of the project. Let's say, for example, in your factory, you need to build a new production line, which is very critical to your product that you're manufacturing, and you need to maintain your market share. So even if this investment will give you a rate of return of 5%, you will accept it because this project is very necessary and has to be done in this period. So even if it gave you 1%, you might take it and accept it. It depends on the case. Now, also the type of organization sometimes plays a role in determining the level of the MARR. For example, if we have non-governmental projects which seek profit, on the other side we have governmental projects that do not seek profit. Let's say, for example, the government decided to build a tunnel in a certain area to minimize the traffic at rush hour in a certain area to facilitate the situation for the citizens passing through this area each day. So the tunnel will be built. However, there might not be a rate of return for this project. And the government will do this project with very, very minimum rate of return, or sometimes with no return at all. It's only a cost to help the citizens. But in this case, the government will do this project. So sometimes you will do the project with low MARR, sometimes with a high MARR, sometimes with no return at all. So these are some of the few elements that determines what is the level or what is the minimum attractive rate of return of any project so that you can take a decision whether to go for a certain investment or not. The most used method for evaluation is the present worth method. We have learned previously how to get the present worth of any cash flow, which is done by discounting all the inflows and outflows to the present time. But this time we will be using the interest rate, which is the MARR. So I will say that the interest rate will be, let's say, 10%, which is the minimum attractive rate of return that the company is willing to take in order to do the project. Then I will see, are the benefits exceeding the cost of this project at the MARR? If yes, if the present worth is positive, then this is a good investment and I will do it because it satisfies the MARR. I'm getting the minimum attractive rate of return. So let's look at this exercise here. Consider that a project has initial investment of $50,000 and that it returns $18,000 per year. Per year, this is your keyword to know that this is an annuity. For the next 4 years, this is your period. If the MARR is 12%, is this a good investment? So you see now I'm stating the MARR, okay, based on the company doing this project. This company will not do this project if it doesn't give me a rate of return which is at least 12% or more. So using the present worth method, I will put the cost included. What do I have? I have an initial investment. So initial investment, it happens at time 0. I'm paying now $50,000. So it's already happening at the present. But since I'm paying this amount, so the sign of the $50,000 will be a minus. I'm paying it, okay? Now at this stage, I will have to be more careful about the signs. So always the initial investment is followed by a negative sign. Then I will start to put the benefits. Here I said that this project returns $18,000 per year. So this is an annuity and it's a gained value. So plus 18,000 into P knowing A, 12%, 4. This will be the value of the present worth. These are all the costs that are included. We only have an initial investment and an annuity which has a plus sign because it's something gained. So the final answer, as you can see here, is 4,671.4. So this is a positive value. It's greater than 0. Then this is a good investment. So you will do the project. So you see, we will benefit from what we have learned in the previous chapter so that we can make a decision about a certain investment. Now let's look at another example here. We have an investment of $10,000 that can be made in a project that will produce uniform annual revenues. So this is an annuity of 5,310 for 5 years. This is N. And then we have a market or salvage value of $2,000. We have explained previously what is the salvage and market value, which is a future value that you will get at the end of the useful life of the project or the investment. Now I have annual expenses of $3,000. This is a negative value. It's something paid. The company is willing to accept any project that will earn 10%. This is the MARR. You see, 10% per year or more. At least I will agree on taking 10%. If it's more, then this is better. Show if this is a desired investment by using the present worth method. I just here tabulated the values. So I said that I have annual revenues of 5,310. What will be the present value of this annual revenue? P equals A into P knowing AIN. So that's why I multiplied the 5,310 by the P knowing A factor at 10% and 5 years. We have a market value of $2,000. This is a future value. So the present value of any future value will be P equals to F, which is the 2,000, into P knowing FIN. The initial investment is already at the present, so I don't multiply it with anything. Annual expenses, we have expenses of $3,000. So again, this is an annuity. P equals A into P knowing AIN, so that's why I multiplied with this factor. Now what did I do here? I added the values which are positive alone and the values which are negative alone. So this is the cash outflows. I am paying $10,000 for the investment and I'm paying expenses of $11,372. How did I get this value? It is the final answer of 3,000 into P knowing A 10% 5. And I summed up these values. I got the value 21,372. Now I will be looking at the inflows, the money gained. So what do I have? This 20,130 is the result of multiplying the 5,310 by the factor P knowing A 10% 5. And we have the market value of $2,000 multiplied by the factor P knowing F 10% 5 gives me the value of 1,242. So if I add this total inflows, I will get 21,372. Or you can do the solution using the equation as we already know. P equals the minus initial investment plus revenues minus expenses into P knowing AIN plus the future value. Now here what I need you to notice is that the present worth was 0 since the inflows equal exactly to the outflows. So here if the present worth is 0, do I accept the project? Should I do this investment? Yes, I do it. So even if the present worth equals to 0, this means that this is a good project. Why is that? It is a good investment since when present worth equals to 0 at the MARR, this means that I got exactly the value of the MARR and I was requesting 10%. So this means that I got 10% exactly. So this is a very good investment. This is the minimum attractive rate of return that I requested and I got it. So this is a very good investment. So when you get present worth equal to a positive value, let's say $1, this means that you got the 10% plus an extra value. This means that you got a little bit more than the rate that you have requested. So this is a very good thing. So even if the present worth equals to 0, this is a good investment. So your rule for accepting any project is when the present worth is greater than or equals to 0. Now we will use the future worth method in the same manner. What will we do? We will get all the values that I have in my cash flow into the future instead of the present, and I will see. By looking at this example here, I have $45,000 investment, so this is P, and this for in a new system projected to increase revenues by $14,000 per year. So this is my annuity, and N equals to 5. We have a market value of $4,000 at the end of year 5 using future worth. So from now on, I will specify the method of solution. So using future worth and a MARR of 12%, is this a good investment? So you will have to get used to the types of questions being asked from now on. I'm asking for your decision. So what will be the future worth? What do I have? Initial investment and annuity and the future value. So when I'm dealing with the initial investment, this is P and I want to get its F. So F equals P into F knowing PIN, and I have an annuity. What is the future of the annuity? F equals A into F knowing AIN plus a salvage value which is already future, happening at the future. So I will say plus the $4,000. I don't multiply it with anything because this is already the future. So what will be the final answer of the future worth? It is 13,635. So it is a positive value. Then this is a very good investment, because here, if the future worth was 0, then I got the 12% MARR. If it gave me a number greater than the 0, this means that I got more than the 12%, which is great. Using the annual worth is another a solution or another method for assessment of the project. You will get the value of the annual worth, knowing that the annual worth is positive when the revenues exceed the expenses. So what do we have to do? Follow the same steps. Calculate the annual worth. If it's positive or equals to 0, then this is a good investment. Now, there is one point that is new here with respect to the annual worth. Sometimes I will just ask for the capital recovery. What is the capital recovery? It reflects the capital costs of the asset and how is it distributed over the life of the asset. Okay, so the capital recovery has an equation. It is the initial investment and it is the salvage value. Okay, here the capital recovery, you must understand that it is an annual equivalent cost. So as if I'm getting the annuity. Okay, but I'm getting the annuity in terms of the initial investment and the salvage value. And I'm seeing how is this initial cost, how was it distributed across the life of the asset. So I will be following this equation, capital recovery, which is an annual equivalent cost, equals I, as if I'm calculating P. If I want to calculate A, knowing P, then I will have to multiply it by the factor of A knowing PIN. Now the salvage value is a future value, and remember I'm calculating A, annuity, so A equals F, so the salvage value must be multiplied by the factor A knowing FIN. Now using this example, you will be able to understand better how do I get the annual worth using the capital recovery. I can still use the annual worth as we used to do previously. Change all the values in terms of A. But only when I ask you for the capital recovery, you will be using this equation. So let's read the example together. Here we have a project that requires an initial investment of $45,000. So this is what? This is P. And we have a salvage value of $12,000 after 6 years. So this is F. We have annual expenses of $6,000. This is an annuity. And annual revenues of $18,000. Another annuity. Using MARR of 10%, determine the annual worth of this project. Now, I will show you how to do it using both methods, the normal annual worth and the annual worth with capital recovery. So using the method of annuity that we learned previously, I will get A. All the values has to be changed into A. So I will say, here I have an initial investment, so this is P. And I want to calculate A, knowing P. So the first value, which is the investment, will be minus $45,000 minus, because it is an initial investment, always multiplied by a minus. And it's a present value, so the annuity of this present value is minus $45,000 into A knowing PIN. Plus, we already have an annuity revenues of $18,000 and annual costs of $6,000. So these two values are already an annuity. So how do I get the resultant value? It is the revenues minus expenses, so $18,000 minus $6,000, and I do not multiply it by anything. The value is already an annuity. Now what's left is the $6,000, which is a future value, and I want to change it into annuity. So it's F, so A equals F, so I have to multiply it by A knowing F, IN. The final answer is $3,223. It's a positive value, then this is a good investment. Now I want to show you the second solution using the capital recovery method. Now with the capital recovery, we agreed that it is an annual worth or an annual cost, okay, calculated in terms of the investment and the salvage value only. Okay, so this is how we calculate the capital recovery. Now it is already a cost, okay? So when I say the $45,000, it is an initial investment. We said that it has to be multiplied by a negative sign, right? But since I'm saying that this is a cost, already a cost, so I know that I have a cost of $45,000, okay? And I want to get its annuity. So I have to multiply it by a factor of A knowing P, IN. Since this 45,000 is P, and the capital recovery as if I'm getting A. So A equals P into A knowing PIN. Now I know that the salvage value is a positive value, but since I'm getting the cost, so with respect to the cost, if this is a gain, so I have to multiply it by a negative sign, because I will be subtracting the salvage value from the cost of investment. So here you will notice that the signs are inverse. Okay, so the initial investment, because I'm getting the cost, we'll say this is a cost of $45,000, and the salvage value, since it's gained, I will subtract it from the cost. So I will say we have a salvage value of 12,000, so this is F, and I'm calculating the capital recovery, which is an A. So A equals F, so I will multiply the salvage value with an A knowing FIN factor. So I got the value of the capital recovery alone, okay, which is 8,777. Now, what will be the total annual worth? You have to know this rule. Annual worth is the revenues minus expenses minus the capital recovery, because we agreed that the capital recovery is a cost, so minus sign. So what are the revenues? We have an annual revenues of $18,000. We have annual costs of $6,000. So I will say annual worth is 18,000 minus the expenses of 6,000 minus the cost of the capital recovery, which is 8,777. And you will see that we got the same answer as the first method. So this is a positive value, then this is a good investment. Now, we will only use the capital recovery method only when I tell you, because sometimes the question will ask you to get the capital recovery only on its own. Okay? This is a representation of the distribution of the initial investment over the life of the investment or the project. You got an initial investment and you have a salvage value. How much did you recover at the end of the useful life of the project? This is the representation using the capital recovery. How much did I recover out of the capital that I have paid? So if I didn't ask for it, you can solve using solution 1 if you find that this is easier.